Have you ever wondered why some people choose to invest in real estate or compared investing in the stock market with investing in real estate? Which might be the better tool for increasing wealth or creating income? Hi, I'm Mike Jacobson.
And I'm Harlan Merriam. Hi there. We're from Tune Investments.
Stocks and real estate are two well-known vehicles for getting you to financial independence, and each has its own distinct advantages and challenges. While many people are familiar with stocks and bonds, there exists an entire realm of possibilities with real estate that is often overlooked. What if you can enjoy the benefits of real estate without being a landlord?
So let's explore stocks or mutual funds and real estate, comparing the pros and cons so you can make a better decision and potentially boost up your financial egg. What are mutual funds, Mike?
Well, they're a common, widely known and used investment vehicle that serves as a basket of various stocks. This diversity provides a significant advantage. With one fund, you can own a piece of 50 stocks or more. That's like 50 different companies. And the mutual funds are managed by professionals. They require less individual research, and that makes them a time-efficient option. How many people do you know that have the time to research 50 stocks for their nest egg?
Yeah, and they're highly liquid. We'll look at that, but they allow you to buy and sell at the push of a button, and they're easily accessible to people like you and me. They're employed in our 401k plans. They're a common starting point for many investors. On a personal note, I spent a substantial portion of my early adulthood strictly invested in mutual funds.
Yeah, real estate, in contrast, is tangible and palpable. It's an asset that always has value, never goes to zero like some stocks. Anybody here remember Enron?
I do.
Right. The advantage here lies in the ability to see and physically engage with the asset.
Real estate does require some additional learning, of course, perhaps for you, such as ways to invest in real estate that are passive. Let's walk through several factors to consider as people choose, Mike.
All right, let's start with the risk and returns. Mutual funds can be enticing. They're offering dividends and diversification to reduce the risk, and the average annual growth is about 9 to 10%. So, okay, that can be impressive, but volatility remains a constant companion. Historic events such as Black Monday in 1987, the dot-com bubble burst in the early 2000s, the global financial crisis in 2008, and then more recently, the unprecedented COVID pandemic in March of 2020. All of these underline the unpredictable nature of the stock market, and it can take years to recover.
It really can. Do you remember any of those particularly, Mike?
Yeah, all of them. But in particular, Black Monday, 1987, when the market dropped 35%, I think, in one day, and someone said, it's only a paper loss if you sell. Well, when we get close to retirement years, people have to sell. What happens if your nest egg has dropped 35% in value and you still need to draw out the same amount every month to live on? Are you comfortable with writing out gains and losses of 40% in a single year or a week? Sometimes it takes years to recover from that drop.
And real estate, of course, has its ups and downs, its volatility as well. But we found that it brings a much higher potential return for you and other unique advantages. We've learned that multifamily, for example, apartments have been a very stable investment over many decades.
That's right. Everybody needs a place to live. And investors have experienced consistent returns in the mid-teens and higher, demonstrating the resilience of real estate even in challenging times. Positive cash flow acts as a cushion. I like to say cash flow is king because that lets you ride out the ups and downs. And that helps prevent the impulsive reactions to the market emotions. The lack of liquidity in real estate also imposes a level of control, so you don't just sell when things do turn down a little bit. So that prevents your hasty decisions. So let's look at the capital requirements for each.
And they're very likely very different capital requirements. You noted that you could buy in at $50 a month, and mutual funds hard to do with real estate. And mutual funds have that low entry barrier. You can start with a minimum amount and make automatic investments if you want to. It's very, very broad spectrum availability. Contrast real estate, a little bit harder, perhaps seems to take a lot more capital to get in. But let us look at liquidity or ease of getting out too, Mike, here.
That's right. That's one of the places mutual funds shine because they are very liquid. Just go to the computer, click the button, you can initiate a sale or a purchase. Real estate, on the other hand, requires a longer term perspective and is more challenging to buy and sell quickly.
And on our way to financial independence, it's important to take that longer look at our investments. Our goal is to generate steady passive income greater than our expenses. How do mutual funds and real estate compare in terms of creating that passive income?
That's a good question. Mutual funds will generate income through dividends and through increase in the value of the underlying stocks. They allow investors to capitalize on the growth in value over time.
And real estate's similar, creating rental income and the appreciation of the property value, but with a lot more control. And there are tax advantages or implications too, aren't there, Mike?
Yes, there are. Mutual funds require investors to pay taxes on income and capital gains annually, particularly if stocks are sold within the fund. Have you ever received a 1099 that showed you had gains during that year and you have to pay taxes when you never took money out of the mutual fund? And that's because the fund manager sold some of the stocks in the fund. Real estate offers several tax advantages that are not available to stocks or mutual funds.
And one of those is depreciation. You can't depreciate your stocks or mutual funds. They may depreciate, but you can't depreciate them for tax advantages here. Rental income is taxed at ordinary income rates, but depreciation can offset that income for tax purposes. Equity buildup is not taxed until the property is sold. Choosing between mutual funds and real estate, there are a lot of factors there, and it's contingent on your individual place in life and your comfort level and your knowledge and your just comfort with investing in one or the other. Get in touch with that so you can sleep at night with your investments.
That's right. And we like to view the investments as a long-term journey rather than short-term gains. So we want to take a balanced approach, incorporating both mutual funds and real estate, and that can provide significant advantages. Mutual funds are an excellent stepping stone for those starting their investing journey, and they offer continued liquidity.
But consider the control you have with each investment and acknowledge that you want to more and more have your strategic decision-making be able to make a difference in your investments.
Also, did you know you can buy real estate in your IRA? Investors can leverage their IRAs or old 401ks to passively invest in real estate.
So as we wrap up today, I suggest you take a sheet of paper and draw a line down the middle and then across the middle horizontally as well. And at the top on the left there, write mutual funds or stocks. And on the other side, write real estate. And then on the horizontal lines there, write pros and cons and work that out for yourself. What are the pros and cons of each for you as you make a decision where to invest the funds that you're making available for your long-term financial independence?
All right. And join us next week as we delve into the practical aspects of employing real estate as a vehicle on our journey to financial independence. So thank you for joining us today. Bye.
Bye-bye now.